Financial Times global finance correspondent Robin Wigglesworth. He's out with a new book, Trillions: How a Band of Wall Street Renegades Invented the Index Fund and Changed Finance Forever. It's about the rise of indexing and the birth and explosive growth of the ETF business. A fascinating read. Robin, congratulations on a great book. He joins us now by phone. All about people, Robin, that we know and love here at CNBC, like Warren Buffett and John Bogle from Vanguard. Now, beginning in the 1970s, index funds started changing the investment world. And then in the 1990s, the birth of ETFs further accelerated the indexing revolution. Can you summarize for the viewers why indexing and passive investing has slowly been conquering the investing world?
Yeah, hi, Bob. Thanks for having me on. Two things, really. It's cost and performance. I think everybody knows about the cost side, that index funds, especially broad, plain vanilla, market cap-based index funds are just a lot cheaper, right? You can essentially buy broad U.S. stock market exposure for 4 basis points now, even for free at some brokerages. And then it's just the performance side, which I think a lot of people still don't really realize that in the long run, the index beats the vast majority of professional money managers across virtually every major asset class. In areas like equities, we're talking 90%. But still in fixed income and high yield, most fund managers still can't be in the index in a 10 or 15-year performance period.
It is rather remarkable of the evidence here. Indexing goes back a very long way. I keep reminding people the Dow Jones Industrial Index started in 1896 with 12 stocks in it, I guess. But modern indexing didn't really start until the S&P 500 was updated in 1956. And what's interesting, and you talk about this in your book, there was a real problem calculating indexes prior to computers. How do you calculate 500 stocks in an index when you don't have a computer around? It was a real issue just doing this.
No, I break out in a sweat just thinking about the work that people had to do this back in the day. When they first started at the University of Chicago to try and find out what the U.S. stock market returned in the long run, nobody really knew the answer. It wasn't until Merrill basically handed a wedge of money to the University of Chicago to find that out. They spent 4 years going through magazine clippings, spools, everything like that, and to piece together what the U.S. stock market yielded in the long run. And that was, not until the mid-60s, really, that we really had an answer to that question. So, everything is easy today, but we forget that, we all stand on the shoulders of giants that spent a lot of work on this.
Yeah, the evidence that active managers are pretty poor stock pickers, it really goes back into the 1930s with the Coles Commission here. But the evidence really started mounting up in the 1970s and the 1980s. And yet, active stock picking is still popular as ever. How do you explain that anomaly, despite the evidence?
Hope springs eternal. It's kind of in our nature that, nobody wants to settle for mediocrity, really. This was one of the most potent attack lines of people in the 70s and 80s when indexing first started to set roots, that, who wants to be operated on by a mediocre surgeon? Who wants a mediocre lawyer? You want the best, right? And you want to be the best. So this wasn't just seen as lazy and passive. It was kind of seen as giving up. I think for a lot of people, it's still the boring thing, right? It's not exciting to say you're invested in a low-cost, well-diversified Vanguard index fund, right? That's not the kind of thing you roll out at parties and you're the coolest person there. No, you want to talk about the individual stocks you've picked, the derivatives you're trading, you're the fund manager that's managing your family's money. That's the kind of stuff that's cool. And that's just, sadly, human nature.
Yeah, and it wasn't really until the advent of behavioral finance that we started to understand that how to scratch that itch. Bogle even had to address this issue many times, where we talked about the idea that, okay, you should put 90% of your money in index funds, but if you have to scratch that itch, go ahead and do 10% and try to pick stocks or pick funds. But he said, he made it very clear, he thought it was a pretty fruitless endeavor. So I guess the important point here is behavioral economics tells us a lot about why people still want to scratch that particular itch, I guess. You know, it's one thing to have an index, but one of the things I found amazing is nobody actually had an investable index until Jack Bogle started up Vanguard and created the first S&P 500 fund in, what was that, 1973, I guess. He faced a lot of opposition from people in the industry, and even then, there were people who thought this was a waste of time. You spent some time explaining that in your book and Jack's uphill battle to try to figure out how to get people interested in this business.
No, it's easy to forget now that the Vanguard 500 fund is now one of the biggest investment funds in the world. I mean, it's bigger than many standalone asset managers. It's as big as many sovereign wealth funds. But when it launched in the mid-70s, it was known as Bogle's Folly because it was such an abject failure. Just a colossal failure. I mean, they thought they might be able to raise $300 million at the time, and they kept lowering their projections until they thought it might raise $20, $30 million. And when it launched, it only raised $11 million, which wasn't even enough to buy all the stocks from the S&P 500. This goes to show that sometimes, you know, from tiny acorns, mighty oaks can grow.
Yeah. You know, we know about the oceans of money moving from active to passive management, and much of it's going into ETFs. That's what we cover here on this show. Is the evidence still supportive that low-cost indexing outperforms active management when fees and expenses are taken into account? Is the evidence still there?
Yes, very much so. I mean, just recently we had the latest snapshot of active versus passive come out from Morningstar, which is one of the more comprehensive studies of this alongside the S&P Dow Jones. And again shows that the majority of active managers over the last year have failed to beat their benchmarks. In some years, you know, you might even see that number go above 50%. Some years it might be around 30%. But I think the thing to really remember is that, you know, the data can change from year to year, but overwhelmingly less than half manage to beat the index in any given year. And over any rolling 10-year period that you care to look at, I think the data is around 10 to 15% of managers manage to beat the index. And that's basically right. What you'd expect from this random chance.
Yeah, the two companies who put out the data on this, Morningstar and S&P, pretty much agree. And the most recent data came out just on Friday from Morningstar. Only of large cap fund managers, only 11% outperformed over 10-year periods. 11% outperform their benchmark. I think what's important about these new data sets is that they adjust for survivorship bias, Robin, which is something that's very important. Lousy fund managers tend to go out of business, so the funds tend to go out of business, and they drop out of these indexes. So comparing them is difficult because they're not there anymore. So you have an upward bias because only the winners actually survive. And S&P and Morningstar, to their credit, have adjusted for survivorship bias. It's a very important discovery that they had over the last 20 years or so. Simeon, you're an old hand in the ETF business. You're listening to this. Your thoughts on the growth of this ETF business that we cover?
I think I'd like to just share a thought on what maybe you call kind of ETF 2.0, which we like to think of as rules-based strategies. So there are some anomalies in the market, things that are persistent patterns over time, and you can capture them in an index, but not necessarily one that's sort of a plain vanilla S&P 500. We sometimes like to call them rules-based strategies. You know, our flagship ticker NOBL tracks the S&P 500 dividend aristocrats, and those are companies within the S&P 500 that have grown their dividends for 25 straight years. Among the things you're capturing from that is a little bit of earnings surprise almost, because every time a company increases its dividend, it's telling you that its prospects are a little bit better than you might have thought they were, because nobody likes to cut a dividend. So this is also part of the ETF revolution, systematic rules-based strategies that have a role to play alongside those market cap weighted indices like the S&P 500.
And Robin, Simeon indirectly referenced the smart beta story indirectly, and I wonder if you can get some thoughts on that. The community, the investing community, has tied itself into pretzels in the last 20 years, trying to figure out if there is anything other than just buying standard indexes that might outperform. And as you noted, beginning with Eugene Fama several decades ago, there was some evidence that, for example, small caps tended to outperform over long periods, value tended to outperform. There's even been other indications that perhaps momentum strategies might outperform. For the average investor, is it worth pursuing these kinds of strategies? Because the minute I bring up, oh, historically small cap has outperformed and outperformed large cap and values outperform growth, the investors point out in the last 10 years that hasn't happened. You have any conclusions that you've had from your book and your study on this?
No, it's a great question, and I struggle with this as well because the data is the data, and it does show that there are certain factors that can, over time, yield market-beating gains. Even Gene Farmer, the father of efficient markets, has done seminal work on this. But the problem is that the key is obviously in the long run. And if you've been holding a value fund for the past 10, 15 years, that feels too long. That's too painful. And I think a crucial thing is that a lot of investors actually do worse than the market, not just because they try and pick hot stocks or hot fund managers, it's because they typically bail when something goes wrong or they jump on momentum. So actually, the problem with smart beta is that it can be really hard to hold through those long, painful drawdown periods, which is why, although I am convinced by the weight of the evidence that it does work, I think in practice it's really hard for investors to capture that because the discipline needed is almost superhuman at times. I mean, being a value investor the past decade has been awful, right?
Yeah, you would expect some reversion to the mean. I believe in reversion to the mean because I don't think the laws of investing have been repealed all of a sudden. I think the same things that motivate men and women, fear, love, greed, for the half a millennia are still there and haven't gone away. And yet, we would ask, what's the conclusion here? It's still certainly very clear, would you say, that the concept of market timing does not work, that the problem with market timing is that you have to be right twice. You have to be right going in, and then you have to be on an exit strategy. You have to be right going out. And the probability that you will be able to do that consistently over time, not once, but consistently over many, many years, is very small. At least the academic evidence indicates it's very small. Am I correct?
No, that's right. And frankly, even practically as well. I mean, I'm sure you've talked to tons of investors that will admit this willingly, that they might be phenomenal security selectors. They might be even great at constructing a portfolio, but market timing is essentially a fool's errand. And even pedigreed active managers I've spoken to admit that that is something they do extremely warily, just because the data and the history is pretty grim. And I think every big active manager has some sort of horror story about sometimes getting a call right, but the timing horrifically wrong, or sometimes getting a call wrong, but they just got lucky on timing, for example. So I think it is one of those perils that, as Bogle used to say, it's time in the market rather than timing the market that matters.
Bogle also used to famously say, don't just do something, stand there, which is one of my favorite lines ever, because it goes to your point earlier about the impossibility of just not doing anything. Most of the time, if you have a long-term strategy, again, I'm just parroting Bogle, this isn't me talking, if you have a long-term strategy you believe in, most of the time, the answer to most quandaries about what to do is nothing. Most of the time. But this is why I go back to behavioral economics, human behavior argues against doing that. So you're constantly fighting your own nature. And that's part of the problem that we've had for these decades, trying to convince people to simply, generally staying pat, if you have a strategy, is better than trying to fiddle around. The active community, Robin, has thrown everything at indexing. First, it was un-American. Remember that? To go for the average return. I love that poster that was in your book from Luthold. Now they're saying that if too many people go into indexing, it's going to distort the market somehow. How important is individual stock trading for the health of the market, and how much passive investing can the market bear? Or is that a silly question at all? I mean, I get thrown this all the time from the active guys. It's going to take over, Bob.
No, yeah. Well, I think it's a valid question to ask. I mean, I think it's important that even though we can celebrate the boons of passive investing and index investing, you'd be mad to not accept that even positive innovation can have negative externalities. I think, though, in practice, I am extremely unconvinced by arguments that the market's efficiency is being eroded by the growth of passive. Mostly because, frankly, a lot of active managers throughout history were, in practice, closet indexers. They just charged money as if they were trading actively, but, generally hugged the index anyway. I think, there are more mutual fund managers than ever before. There are more day traders than ever before. There's still more hedge fund managers in the US than there are Taco Bell managers. I actually checked that data point recently, and it's true. So the idea that somehow the market is dying, I find that a little bit fatuous. But there are other issues around passive that I think we do need to keep an eye on, at least, and not be blind to that there could be some problems here and there.
Yeah, I agree. Now, can we put any numbers on this? It's kind of hard to figure out, but how big is the passive investing versus active? Is passive investing 30% of the market? Do we have any sort of sense of this overall? It's about, the ETFs are almost 30% of the volume, by share volume in the United States right now, but I'm wondering about the actual dollar value.
Well, by assets under management, if you look at the investment industry in the US, passive is around half of the US equity investment universe. But actually, of course, there's lots of shares that, like Jeff Bezos owns in Amazon and so on, that don't actually trade. So if you look at the overall equity universe, it becomes a little bit different. So I've tallied up the international and the US and the global numbers on index funds and ETFs. And broadly speaking, there's around 17 trillion in various index funds, formal index funds. But then there's all sorts of in-house strategies as well. Big sovereign wealth funds, they don't want to pay and don't need to pay BlackRock and Vanguard a few basis points even to do it. They can do it in-house because it's pretty simple. And by sort of reverse engineering some numbers I've got from BlackRock and others, I calculate that there's probably around $26 trillion in passive strategies. So that's globally and in both stocks and bonds and a few other asset classes. And that is, still, a small minority of the global investable, tradable public market, but it's growing fast by probably north of $1 trillion a year.
Yeah, it's hard to figure out. I constantly ask S&P this question, and they estimate there's $13 trillion directly indexed to the S&P 500. The S&P 500 is probably 36 trillion now, something like that, close to 40. But they freely admit we don't know how many people who are closet indexers that don't pay us to directly index that are out there as well. But it's certainly a fairly large number. It's growing, and it's just a terrific book, Rob, and I really appreciate it. I think you made a very important contribution to the literature.